Hey, what's up guys? It's Ezekiel Chiu here. So let me ask you this. How many times have you marked the support and then you saw price touch it and then you thought, ooh, this is the perfect time to buy, but only to watch the market smash through it like it never existed at all? So if that's you, you're not alone, right? So here's the brutal truth. Support and resistance don't work the way you think. And most traders, they get crushed because they don't know what to look for before price reacts at those levels, right? They just trade the level. But the smart traders, they trade the story behind the level, how price moves into it. So in this video, I'm revealing the two price patterns that predict whether a level is going to hold or is going to break violently, right? And then I'm going to show you the one strategy that I use to consistently profit, whether if it breaks or if it reverses, right? So once you see it, you're never going to trade support and resistance the same way again. Let's get into it. Here's what most traders do. They mark the support and they mark the resistance level, right? And then what? And then they wait for the breakout. When the breakout happens, price smashes through, right? And a lot of times, the traders, they are caught off guard. Ooh, man, they caught off guard. All right, and they miss the trade, or they are chasing in too late. Here's the thing. How do you catch these moves before they happen, right? Let's break it down step by step, right? So check out this chart. Okay, so now let's test your instincts. Price is sitting at a support level, right? So what's your move? Will it hold, right, and reverses upwards, or are we going to see a breakdown? Take a second, look at the chart, Before you answer, let's check out another setup first. If you notice any patterns itself, take a look at this. Look at price approaching the support level here, right? So what's next? Will this bounce, or is it going to collapse and break right through? So here's the thing, right? Most traders, they assume all support in general is going to hold, but that's a mistake. What is important is to look at the way where price moves into the level. That is what's going to tell you the whole story, right? So there are two ways where price hits the support. So I gave you two examples earlier, right? One with force, boom, right? Like this, right? One with hesitation, like the example that I gave you earlier. So when you learn how to read this, you're gonna know exactly what happens, right? So now let's break it down, okay? Number one, fast move, right? The fast move is where there is aggressive momentum that is heading towards the support or the resistance itself. Number two, the slow move, which is a weak and gradual pressure into the support or resistance itself. Okay, so here, the first move that I want you to learn is the fast move. This is when price, it kind of rush into the level with big, strong candles. There is no hesitation. There is no slow build up. If you take a look at this, the market is in a range. It goes up, it goes down with all the big candles. Now, a fast move into the resistance is the opposite, where you observe what? A series of large green candles moving towards the resistance. Big ones moving into the resistance, right? This is what called a fast move upwards. So here's the thing. Why does it matter? If the market hits a level with no major obstacles nearby, the reversal, if it goes up fast and hits a level with no major obstacles, the reversal can just be as swift because there is nothing holding price back from bouncing it fast, right? So a fast mover that goes into the resistance means what? The traders who shorted earlier, right, are sitting on the profits, and what? They may close their positions, right, adding all the buying pressure. If you imagine, right, someone is short in this area of resistance in the market itself, and then the trade quickly went in their favor. So they are already sitting on profits, right? Maybe thousands of dollars in profits. Now, this group of traders is afraid of losing their profits, right? So what happens? They try to take them quickly, right? Which can help to create more buying pressure. So when you are shorting and then you exit the position, it is a buy order. When you short the market and then at the point when you exit the position, it is a buy order that will create buying pressure to then increase the price itself. A fast move into the support level is going to attract aggressive buyers who assume that the level will hold, increasing the buying orders. right? Now, this is significant because why? It is coming into this obvious area of support, and traders uses this area as technical analysis, right? This would trigger the buying pressure as well. A fast move coming into an area of value, right? So when price slams into a support or resistance with force, the reversal is going to be just as aggressive. Why? Most traders would think that, oh, a big move downwards, likely it's probably going to break through. But how many times have you also seen a big move downwards and then it shoot right up instantly, catching you off guard, right? Because why? When it can go down fast, it can go back up fast because there is nothing in between the way of that move, because there is no obstacles over there, right, to slow it down. It can go down fast, it can go up fast. So if the buyers, they step in at the support level, then where is the next logical stop that it's going to have? It's going to be at the resistance, right? So if that resistance is far away, the price has room to run before hitting any major selling pressure. It's only at the top there. So that's why strong moves in, strong moves out, right? The momentum, it doesn't just disappear, okay? When price slams into the support with force, what happens next? Now, if there is no major resistance nearby, nothing is stopping it, right, from just snapping it back fast, right? So you think of it like a rubber band. When it stretches too far, it's going to rebound hard, right? That's why the strong moves into the key levels is going to lead to explosive reversals, right? All the momentum can shift fast from down to up, can shift fast, right? And vice versa. So if you are ready, you can ride the wave early, right, for all this big reversal move itself, okay? Quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. I mean, if you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. Number 2, the slow move. Alright, so this one is a little bit sneaky. Instead of price heading right fast, crashing into the support, the price, the markets slow down with lower highs into the support. So the buyers, what? They are stepping in. No, not the buyers. The sellers are stepping in early, right? Showing confidence that what? The support will break. So this is when you get a series of lower highs into the support. So if you take a look at this, so this is the area of support, right? The market pushes up, but each of the move, it gets weaker. The sellers, they step in earlier each time round, forcing lower highs. If you look at the chart from the left to the right, the market isn't making strong moves anymore. The momentum is kind of like fading away, right? The buyers, they are kind of the buyers that is holding the level. They are running out of steam. So this is not random. This slowdown, the slow breakdown, is confidence, right? And when the final push fails, the drop is going to come fast, right? So this is what we mean by lower highs into the support level, a slow move into support, right? So when the price, it crosses into the support with lower highs, next time you see it, it's no longer a random pattern. It is a warning sign. Okay, this is the nature, the story behind why is their price lower highs and all this stuff. You get it? It's the selling pressure increasing, right? The sellers are stepping in earlier each time. Rather than waiting for it to retrace back up to sell at the top, the sellers are stepping in earlier, increasing the selling pressure. So they are not waiting for the reversal or the bounce back up, right? They're stepping in earlier they're expecting what? A break downwards, right? So but meanwhile, the retail traders, they see price touching the support. They think, ooh, this is a good time to buy, right? So where do they put their stop loss? They're going to put their stop loss where? Naturally, they're going to put it right under the support level, right? And when price finally crack the support level, all their stop losses is going to trigger a wave of what? More selling orders at the area, right? That will fuel the breakdown even further. So this is why the weak moves into the support, they don't hold and they collapse instead. Right? So price slows into support, right? With weak slow moves, this is now a red flag, right? The sellers are stepping in earlier, pushing the price lower with each attempt. Remember, when that happens, you don't want to buy, right? You want to get ready for a sell itself. So now, on the other hand, if you see a series of higher lows into resistance, right? As you can see here, right? This is a sign of a strength in the market, a sign of strength of buyers, right? So this is just the opposite, all right? Each subsequent low is higher than the one before, right? So who is buying before the resistance level? So most traders, the retail traders would buy when it breaks, right? But who is buying before it breaks? The smart money itself. When you see higher lows stacking up, right? Higher lows stacking up, it's not random. The buyers are not waiting for a dip or a break. They are stepping in earlier each time, right? That pressure is confidence. And when the resistance finally give in, it's not going to be a small move. It's going to be a breakout with big time force. All right, so now next, I'm going to talk to you about the strategies that I use that you can profit in these rising and falling markets. Alright, so we'll be using the TAEE method. I'm going to break it down. The letter T stands for trend. Every time when you look at a chart, right, when you see price respecting the support level, right, before that, you want to look at a chart. You want to ask yourself, what is the trend that you see in the chart itself? As you can see in this scenario, the market is in a what? It's in a downtrend. Where do you want to trade? I mean, not just anywhere, right? You want to focus on what? You want to focus on the resistance, right? Where the sellers, where the sellers step in and push the price lower again. So think about it like this. If the market is already falling, would you want to fight it and go against it? So instead of guessing where it might turn, you wait for price to pull into the resistance, you look for confirmation to write the trend back down itself. Alright, so the smart traders, they don't chase when it's falling, right? They position themselves when the market gives them the best shot at entry for the sell downwards. Okay, so now letter number 2 of the TAEE method, the letter A, it stands for what? The area of value. Alright, so here's what I'm talking about. The next thing to do is to wait for price to come towards. So the trend is a downtrend, right? We identified the T, downtrend. So we want to wait for price to come towards our area of value, our resistance level, our area of value. So you can see the price hits the resistance and then break, right? That is where you are waiting for, the area of value. It breaks, right? Wait, you see, it breaks. Now, I'm going to keep going. You're going to see it. Now, the third letter, E, stands for entry. So if you see this candle, after breaking through, right, it forms what? It forms a bearish engulfing pattern. Now, this is a big deal. Why? Because the price tried to push up higher, but the sellers, they took over, right? And they closed it below the previous candle low itself. So this is not just any red candle. It's a shift in momentum. Okay, so if you were going long, you're going upwards, you're going long, right? Let's say the traders, it's going to be a reversal back upwards from downwards to upwards. It broke the resistance, it's going to be a reversal upwards, right? They bought it. And then where would their stop loss be? Below the bar itself, usually, right? So if you go long, you got trapped, right? So then when the bearish bar comes down, what's going to happen? It's going to trigger all the buy orders into stop losses, and that will trigger sell orders itself, right? So now if you're smart, this is the area where we will write the reversal downwards. Okay, so let's talk about this. The buyers, they tried to take control, right, to push the price up higher, but then it was a trap, right? The sellers, they came in hard, they smashed the price back down, and it closes below the resistance level. So that is not just a rejection, it is also a force break, right? It's a force break upwards, right? The market, it kind of lure. The market always does that. It lure the breakout traders only to snap back down, right? Leaving them stuck. So this is, in a way, a classic, a stop hunting move, right? The real momentum is now where? In the other direction. All right, so now what you can do is enter in the next candlestick open. All right, that will be your entry for the third letter, TAEE. Now for the fourth letter, TAEE, the exit, E for exit. So now exit is in two places, right? I'll stop loss and I'll take profit. So stop loss. What you can do, a couple of ways to do it. One is you can place it at the previous high, or you can also use the ATR indicator. That's where you want to set your stop loss a distance away from the resistance level, right? Because we don't want price to reverse and get stopped out easily, right? So to do this, what we want to do, we first identify the high, and then we add the ATR value, right? So for example, it's say 40 pips ATR value, right? 40 pips in this case. So your stop loss will be placed at the high plus 40 pips. upwards. Okay, so now what about our take profit level? All right, so when you look at the chart, if you can see, there are two levels over here, right? There are two lows over here, right? So those are the two levels in a way to watch, right? One is a recent swing low, another one is a lowest low, right? A deeper swing low. I'm giving you all the different ways. What you can do is you can, for example, take some profit at the first target and then maybe at the second target itself. But here's the thing, right? Here's the thing. The market is in a downtrend, right? It's clearly in a downtrend, as you can see. Strong downtrend, right? It retraces up and then comes back down again. So why do we want to settle early, right? Price wants to break lower. So instead of us cutting the move short, we can split our exit into different positions, right? For example, you can take some profits at the first target and then you let the rest of it right downwards, right? So this way you can secure profits, making your trade at least profitable, but still stay in the trade if the momentum keeps pushing it down. So this is where you get good risk, smart risk, and big rewards itself. When the market is in a strong downtrend, it doesn't, and it's probably not going to be likely stopping at the lows. It's often going to break through, right? That's where the breakout is going to happen, isn't it? It's often going to break through and keep dropping itself. So why do we want to settle for a small win when there's a lot more in the table? All right, so this is where we can maximize our trade. We can set two targets. One at the recent low, you secure some profits, and then another one further to secure a bigger move, right? Then you want to plan what happens after the breakout, right? After the breakout downwards. This is where you can use the Fibonacci extension to pinpoint where that target is going to be. So for example, in a Fibonacci extension, there's going to be different levels, 1.25, 1.27 level and 1.68 level, etc., right? The 1.27 level, if you are not aiming too far, is generally also a sweet spot where price reacts. But if you can see, if there's strong momentum, you can even go towards the next level, which is the 1.68 level. How do you draw it, right? You draw it with the swing highs to the swing lows, all right? Using that as a Fibonacci extension, get it? So the goal, as you can see, is using this method is to get the best of the both worlds, right? We can secure profits early to make the trade into a profitable trade already, while leaving room for the market to do what it does best, the trend. So now, take a look at this example. What we are waiting for is price to break upwards, correct? The break of resistance that is in line with the main, in this case, now this case is what trend? Downtrend, uptrend, an uptrend, right? In this case, an uptrend. So uptrend, we are waiting for the break of resistance, right? So we can trade the way that we talked about earlier, right? But most people, what they do is that they trade the breakout. So here's the thing. What if the breakout, it never happens? What if price doesn't break out? If price kind of stalls at the resistance area, but it doesn't really consolidate and it starts to head lower, here's what we're gonna do. We don't chase it. If there's no breakout, we don't want to trade it, right? We want to stay patient. We want to wait for a clean setup. So here's what we're going to do. If you take a look at this, apart from waiting for the breakout, right, there is another potential trading opportunity. All right. If you look at the chart itself, there is an area of support itself. So if price makes a strong drop into the support, now we are combining them together. If price makes a fast move to the support itself, what will be our next move? To buy or to sell? Buy, right? Because after a big fast move, right, an aggressive sell-off, right, the smart traders will what? They will watch for exhaustion in the market, right? And if the support holds and the buyers, they step in, this is your signal to write this reversal, right? We get in early for the move upwards before the crowd catches on later itself, right? And then obviously we want to lock in some profits. We can get out at some take profits at a high before the big move upwards, and then we let the rest ride the momentum upwards, like what we have talked about using the Fibonacci extension itself. Get it? All right, good. Okay, so now let's wrap it up. Breakout or reversal, right? So here's what we want to watch for, the signs, right? Fast move into key levels. They often what? They often bounce, right? They often bounce not only slower, they often bounce faster due to there's no nearby obstacles itself. A slow move into the support, it shows what? The selling pressure building, right? So we can expect a break downwards if it's a downward trend. And then if there is higher lows into a resistance, the buyers are gaining strength, and then a breakout would be likely. A low highs into a support is where the sellers have take control, and likely a break downwards itself. Okay, so now then we talk about what? The TAEE formula, right? The T stands for what? The T stands for trend. So we want to first identify prior to that breakout, price hitting the support resistance level, right? Whether is it an uptrend or the downtrend or a ranging market? All right. So then if it's ranging, we want to stay out of it, right? It's not so clear. Then next, TA. The A stands for area of value. We want to look for entries at key support and resistance zone, which is what we talk about. In a downtrend, we actually want to wait for the retracement before confirmation downwards, right? Hit the area of value before it goes downwards. Then the letter E stands for entry. That's where we can look for engulfing patterns. Not only engulfing patterns, it can be pin bars, it can be etc. Candlestick patterns set up at pinpoint retracements areas. It's like a pullback, right? Before the move downwards. False breaks or other confirmation signals at the area. So then once you have entered, the next letter is the exit, E, right? That's where you can place your stop losses at previous highs or using the ATL. And then for your take profit target, you can get out early partial profits and then use Fibonacci extension. All right. So then that's where for trade management, you can also lock in key profits, right? Which is what we talk about. We lock in the key profits, we lock in some profits, and then we let the trade right itself to ride the trend. And what if there is no breakout? Like for example, we are waiting, there's no breakout, right? We wait for price to come to our area of value. We get in early before the crowd catches on itself. Good? So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.